If you're already running a business and you've been doing it for a little while now, incorporating your business will also include another element to consider, which is rolling your sole proprietorship or partnership into the newly formed corporation. But first, this channel is full of all things small business, tax, leadership, business improvement. If you have a question, chances are we have a video, and if we don't, just let us know and we'll do one. Also, if you're not a Swain CPA client, book a chat. Let's do something about that. Okay, back to rolling your business into a small business corporation. Think about it this way. You're essentially selling the business to another entity. Yes, you own that entity, and for all intents purposes, it's you, but make no mistake about it, you are in fact legally selling a business. Now, why am I asking you to view it in these terms? Well, because that's the way that the CRA, the Canada Revenue Agency, views it. And whenever there's a transaction in Canada, there's a tax event. And it might not always be taxable, but there is an event that requires thoughtful consideration. Now, in most cases, with various exceptions, if the tax event generates a profit or a capital gain, the CRA are going to get their cut. So you might be thinking that you can just sell your business to the company for $1. After all, you're just dealing with yourself and you're really not selling anything. You're just operating under a different structure, right? I wish it were that easy. You see, there are rules in the Income Tax Act that ensure that when related parties are dealing with each other, and in this case, you are related to your company by the fact that you own it. It's like a child of yours. The transactions are deemed to occur at fair market value price, as if you were dealing with a non-related party. And it doesn't matter what price you actually transact at, like $1. Deemed, in this case, means a pretend or forced number. So you may be asking yourself, is this business really worth anything? And you might think, not really, not without me. Or you might be looking at all the capital assets you have and tallying up the value and saying to yourself, there might be a tax bill, but it won't be too bad because there's still lots of cost base in my depreciable assets and the gain wouldn't really be too high. Or it might be in the opposite. You might be second guessing doing the incorporation at all now because when you crunch the numbers, there might be a larger value that might cause a tax bill that you may consider vomiting over. There's a happy ending coming here. That does come at a cost, but it is important that you understand the perspective of things from the CRA's point of view, not yours. Because in this case, if you sort of look at this like a game, then the CRA is your opponent and we must understand our opponent's attack patterns and motivations if we want to play the game to our advantage. So the CRA's motivation is to maximize the amount of tax it collects from taxpayers within the letter of the law. Okay, so knowing this, they're going to look for ways in which your business is more valuable than possibly even you think, right? The higher the deemed value, the more tax they will collect, right? So they're not just going to be looking at the underlying value of the capital assets you have, right? They'll be looking at the goodwill of your business. Now, I think we all think we have a good idea what goodwill means. The book of recurring business we've been able to build, or maybe a great brand with all the stuff behind a great brand, such as websites, and maybe a great little team of people that are really aligned with the business's purpose. All that good stuff, right? But from the CRA's perspective, it's not that romantic. They're just going to take an average of your business's income levels over the years and apply a multiple, and we don't know what multiple that'll be. And they'll likely not be that picky or conservative about finding ways to bring down that number, ironically. Because remember their motivation here. Now, I did say there was good news, right? And there is, so stay tuned. So right about now, you want to be bailing on the whole thing. Or if you're in gaming mode, you might be thinking, is there an invisibility cloak I could acquire, put me off of CRA's radar? Or is there a special shield that I can defend myself from the attack? As I'm saying this, it kind of feels like Dungeons and Dragons, doesn't it? But thankfully, yes, there is a shield in this game. And it's a section of the Act that allows us to roll the business into the company without triggering any tax bill. Now, this part of the Income Tax Act is called a Subsection 85 rollover. And you don't have to worry about remembering this because your CPA and your lawyer will know what I'm talking about. But you will be ahead of the game understanding this. Now, what does this mean to the process for getting incorporated? Not much on your end, other than some additional information that you will need to assemble for your CPA. But from your end, there's not much more to worry about. However, A subsection 85 does complicate the process for both the CPA and the lawyer. So you can expect the fees from both professionals to be higher than if you're just freshly starting a new company. So you might think of this extra cost as a bit of an insurance policy to protect you in the event the CRA deems there's a tax event. Now, another concern people have is this: what about the value of the assets that I paid out of pocket that got rolled into the company? Will I get reimbursed for that? What about the cash in the bank or the receivables, supplies, all that nitty gritty? What about that stuff? Yes, normally you will get a credit to your shareholder account, and this just means that you can withdraw the equivalent of this credit in cash as a tax-free withdrawal from your new company. But the value will be equal to the tax cost of the assets you are rolling into the company, not the fair market value. And that's important because if we elected to receive the fair market value, then we are going to create a tax bill, and that defeats the whole purpose. So as an example, let's say you have a workshop that you wanted to roll into the company, and the workshop had a fair market value of $300,000, but the undepreciated capital cost value was $150,000, or in other words, the original cost value of the company minus any depreciation, or what accountants call capital cost allowance, written off over time. And for this particular asset, you will get a credit for $150,000 as a shareholder payable that you can withdraw at your leisure, provided the money is there and it's tax-free. And that makes sense, right? Because you paid for this workshop with after-tax dollars, so you shouldn't get double taxed again when you take out the money to replenish yourself for that asset that you provided to the company. And there you have it. You've officially rolled your proprietorship or your partnership into the company without immediate tax consequences. Congratulations. We'll see you next time.